So I nearly missed out on a fantastic opportunity to buy my first home because I was listening to people's thoughts on 95% mortgages. People said 95% mortgages are bad, that the mortgage repayments would be unbearable, and I would run the risk ultimately of going into negative equity. And although I do fully acknowledge that there are some important things to consider before getting this type of mortgage, I am pleased to say that after assessing our own personal situation and also reviewing things with a mortgage broker, we decided that we were going to buy our first home with a 95% mortgage. And boy, did we make a good decision. So in this video, I'm going to be sharing what a 95% mortgage is and what this new scheme the government are offering could mean for you as a home buyer. I'll also discuss the pros and cons of 95% mortgages, and lastly, I will discuss the most important things to consider before getting a 95% mortgage and ultimately why we decided it was the right decision for us. So I hope you find this video useful and hear the experiences of someone who actually has a 95% mortgage, because truthfully, there is a lot of noise currently on the internet about these mortgages by people who actually haven't had experience with them and they've never had one themselves. So I hope my discussion today will be useful for you. If you're new to my channel, it is great to have you here, of course, and I encourage you to check out some of my other videos on my channel about getting your finances in check, how to start investing as a beginner, and how to work towards financial independence and many other topics in between. Also, don't forget to like any video that you enjoy and that you like, and also subscribe so that you're aware whenever I upload a new video. So let's get into this. So in a recent poll that I had put on my community tab, which if you haven't realized by now, I really love a poll, 26% of people voted that they would stay far away from 95% mortgages, 50% said they are okay, but they wouldn't personally use them, and 20% said they are good products, and 5% thought they were fantastic products. If you're someone who voted, thank you so much for voting. I love to see what you guys think about these topics, so I will be doing lots more polls. So traditionally, a 95% mortgage meant that you as the potential home buyer would only need a 5% deposit, and the lender, which would be the bank or the building society, will put in the remaining 95% of the money needed to purchase the house. You and the bank then have an agreement that you will pay them back that 95% that they have loaned you plus interest in a set term, and that set term is usually over 25, 30 or 35 years. Due to the pandemic and the financial hit that many markets and sectors took, lenders decided to withdraw the 95% mortgages that they were offering as they wanted to take off their most risky mortgage product off the table. This meant that people who were working so hard towards saving a 5% deposit had the rugs pulled out underneath them essentially. And a lot of times we hear only 5%, and so I don't like that as much because 5% deposit of a house is still a lot of money. So to have the rug pulled out underneath you would have been absolutely demoralizing. But thankfully, as of April 1st, 2021, so right here, right now, the government have decided to launch a scheme whereby 95% mortgages are now back on the market. The only difference between this scheme and the traditional 95% mortgages is that the government guarantees the mortgage over 80%. So they guarantee the 15% and the home buyer will of course still put down that 5%, so that basically the lender can feel confident that if the homeowner is unable to make any mortgage payments for whatever reason, the government has guaranteed at least 15% to the lender. So this scheme is open to all first-time buyers and home movers in the UK on any property worth up to £600,000. This scheme is not available for buy-to-let mortgages or for a person buying a second property that wouldn't be their main residence. This scheme is only available for repayment mortgages, so not interest only, and the regular affordability checks will of course still be conducted. And this scheme will be in place until December 2022. So in summary, this new scheme has basically just made lenders feel more confident in offering these products again, which they used to offer, as the government is taking on some of the risk associated with this type of mortgage. And this is now allowing home buyers with smaller deposits a chance to get on the property ladder. And the great thing about this scheme is that the government does not own any portion of your home, you would still own your own home. So now let's talk about some of the pros and the cons of 95% mortgages. So let's start with the pros. So the first pro is that you can save less money. So saving for a 5% house deposit, for instance, on a £300,000 house versus a 10% deposit for a £300,000 house will be £15,000 versus £30,000. The second pro is that you can have more money saved towards home improvements. So if your deposit needed is smaller, then you probably, or you may be able to save more money towards home improvements or even furnishing your house. This is especially important if you're buying a house that's somewhat of a fixer-upper, as you'll need some cash to make the repairs. But the upside to this is that you'll be automatically adding value to the house by getting it in better shape than what you bought it at. The third pro is that you can get on the property ladder quicker. So this is great, especially if you are currently a renter, as you can turn those rent payments that you're making on a monthly basis into mortgage payments towards your own home. So as cliche as it sounds, instead of paying off someone else's mortgage, at least you're paying off your own. Also, if you're looking to buy in an area where house prices are constantly going up, getting on the property ladder sooner rather than later means that you can buy a house before the next surge in house prices occurs. The next pro is that you can benefit from increasing house prices. So overall, by getting on the property ladder quicker, if house prices increase in your area, then you get to benefit from that increase in house prices and ultimately build more equity in your home. So for cons, the first con is higher interest rates. So as you have a smaller deposit, you will have a higher loan to value. And essentially that means to the lender that you have less skin in the game from their perspective, and therefore you're paying a higher interest rate than if you had a larger deposit. The second con is that the higher interest rate results in higher mortgage payments. So as a result of the higher interest rates, ultimately your monthly mortgage payments will also be higher. The third con, which you may hear a lot, is the risk of negative equity. So a lower initial deposit means you have a higher risk of being affected by house prices decreasing. If a house price was to drop beyond what you owe the lender for the mortgage, you would then be in negative equity as you would owe more than what the property is worth. And another con is the difficulty to remortgage, and it's all kind of like a domino effect. So if you are in negative equity, then it does become more difficult to remortgage your house because again, you owe more than what the house is worth. This is really problematic if you want to move, of course, and it's also problematic if you want to get to a lower interest rate. So say your fixed interest rate term has ended and you need to renew to get a lower interest rate, that can be a problem. So now let's talk about some important considerations for 95% mortgages. So as you can tell by the pros and cons, there are a number of things that need to be weighed up. I think the biggest one of them all is to decide whether you could save up a 10% deposit quick enough to beat the rising house prices. So if you are working towards, or you do currently have a 5% deposit, how long would it take you to save an additional 5%? So if for you that is maybe 2 to 3 years, you then have a difficult decision of whether you think in those 2 to 3 years house prices will stay the same or only go up by a little bit, so that your 10% deposit will still kind of hold its value to buy what it is that you want. The risk here is that in those 2 to 3 years, if the house prices rise, you may then need to save even more, which will take longer, and then you can kind of end up with this hamster wheel of having to constantly save more to meet the increasing house prices. The other important consideration is, can you afford the higher mortgage payments? As I said earlier, low deposits generally mean higher interest rates, which has an effect on your monthly mortgage payments, which ultimately makes them higher. However, the reality behind this is that affordability checks will be conducted, and they will check whether you could afford the mortgage payments on your home. And not only do they look to see if you could afford the mortgage payments at the interest rate they're offering, but they also check to see if you could afford mortgage payments if the interest rate was to rise. The next thing to consider is, how much house can you afford? So again, with a low deposit, that means you have less to put towards the house, so you may need a slightly higher income to get the type of house that you want. So the general rule of thumb to calculate how much house you can afford is your income, or the joint household income you have, times 4.5 plus the deposit you have. So let's go through some examples to put this into context. So for a £200,000 house, a 5% deposit of £10,000 would require a household income of £42,222, whereas a 10% deposit of £20,000 would require a household income of £40,000. For a £250,000 house, a 5% deposit of £12,500 would require a household income of £52,777, whereas a 10% deposit of £25,000 would require a household income of £50,000. For a £300,000 house, a 5% deposit would be £15,000 and would require a household income of £63,333, whereas a 10% deposit of £30,000 would require an income of £60,000. For a £350,000 house, a 5% deposit would be £17,500 and would require a household income of £73,888, whereas a 10% deposit of £35,000 would require a household income of £70,000. For a £400,000 house, a 5% deposit of £20,000 would require a household income of £84,444, whereas a 10% deposit of £40,000 would require an income of £80,000. For a £450,000 house, a 5% deposit would be £22,500 and would require a household income of £95,000, whereas a 10% deposit of £45,000 would require a household income of £90,000. And last but not least, for a £500,000 house, a 5% deposit of £25,000 would require a household income of £105,555, whereas a 10% deposit of £50,000 would require a household income of £100,000. So I hope those numbers gave you a bit of food for thought as to what the difference would be between a 95% versus a 90% mortgage. In my opinion, the household income needed isn't a huge difference, but where you see the big difference is the amount of the deposit size that would be required depending on which mortgage you choose. So you really do need to weigh up what works for your personal circumstances. So now I want to speak to why we personally chose a 95% mortgage and why it worked for our situation. So ultimately, for us, as I have heard is the case with many others as well, the issue was about saving a large enough deposit in a fairly short amount of time, more than it was about not being able to afford a mortgage. So we decided that we didn't really want to take the risk of saving up for a 10% deposit, which would have taken us a few years to save, versus the potential increase of house prices in those few years. And we really made a good call on this one. We purchased our home less than 2 years ago, closer to a year and a half, and in this short amount of time, the house price has gone up by around 20%. So if we were still saving now, which we would be for that 10% deposit, we would not be able to afford our now home. Also, the increase in the house price that we've seen and the houses in our area means that we now have a good amount of equity in our house. So when it's time for us to remortgage, we will be bumped up to the next LTV loan to value bracket, which will mean our interest rate will decrease as well as the monthly mortgage payments. Another decision that we made was to move to an area that had a lot of growing potential to do our best to avoid a negative equity situation. Of course, you can't predict, but you can try your very best to fight against this. So although we were both born and raised in London, we knew that London was unaffordable and could potentially see a stagnant or decreasing housing market in the next few years. So we chose an area which we felt hadn't reached its potential yet, and also where we'd be able to afford a house that we could grow into for some years. The reality with negative equity is that it's much like investing. So you're not actually impacted by a drop in your house price until you want to sell it. So if you buy a house that you are comfortable to live in for 5 to 10 years, for instance, you would have probably ridden out the negative equity situation by both paying down your mortgage principal each and every month over those 5+ years, but by also allowing time for the house prices to stabilize, or better yet, eventually increase again. And lastly, I would say it was very much about affordability. So although the mortgage lender does their own affordability checks, we aim to buy a house that would result in monthly mortgage payments of below 30% of our net income. And that is really the gold standard that you should work towards. And by net income, I mean the income that you will receive into your bank accounts after tax and pension contributions. So by doing this, it meant that we could try our best to avoid a negative equity situation. So we would either be able to afford mortgage overpayments, which would help us to build more equity in the house because we'd be paying down the principal, or in the worst case scenario, that we would not be able to remortgage after the fixed rate term was up because of the negative equity. Even if we were put on a variable interest and the interest rate was to rise, we would still be able to comfortably afford the mortgage payments because we made sure to stay within our means. So it really is about looking at your own situation, running the numbers for yourself, and really just being wise about the decisions that you make. A really important thing for me about making this video was to put a positive light and a positive spin on 95% mortgages, because as I said at the beginning, it seems that lots of people are speaking negatively about them, but I am someone who's greatly benefited, and there are thousands of others who found this to be a really effective way to get on the property ladder and buy their future home. So I really hope that you found today's video useful, insightful. I'd love to hear your thoughts and your opinions on this. Are you someone like me who has used a 95% mortgage, or are you one of those people who are totally against them and aren't interested? I'd love to hear your thoughts. And if you are someone who's currently looking to buy in the next year or two, I wish you all the very best on your home buying journey. It's a long and stressful process, but it is completely worth it at the end of it. So that's it for today. Take care, and I'll see you in the next video real soon.